I'm Sarah Bunwell, the editor of fundoperator.com. I'm here with Richard Hubbard, independent trustee at Capital Cranfield. Richard is speaking at our ESG Investment Leaders Forum later this year, and ahead of that we wanted to catch up with him to get a bit of a flavour of what he's going to be talking about. Hi Richard, thanks for joining me.
Good morning.
So obviously we're going to be talking about all things ESG, and in particular I want to talk about kind of how trustees set their ESG priorities and strategies. So my first question, which I think is quite a tricky one, is, how can trustees make sure that they've got the right investment priorities when it comes to ESG?
Well, this is not surprisingly a massively complicated area, but I think we make it far more difficult than it is. If you're one of the monstrous big funds, tens of billions, you've got the resources to get in a deep philosophical and scientific analysis on this. If you're a small fund, it's actually relatively simple. You need to work out a small number of things you think are a priority, and then you need to go after them. But there's no kind of expectation that anybody around that trustee body needs a really deep technical knowledge of value at risk in trading systems, or a really deep technical knowledge of value at risk in climate change modelling. You just need to work out a small number of priorities, and arguably who you're going to follow. There are plenty of people who are real thought leaders in this space, trying to redo the work they do. We haven't got the competence as trustees of small and medium-sized plans. Settling down and taking something like Transition Pathway Initiative or Climate Action 100, they give a good proxy. They've got substantial resources behind them, and you don't have to get this right either. You just have to be heading in the right direction. One step on the road, take that step, and then have a rethink later in the years to come. Bring your advisors back in and have a look at what you've got right, have a look at what you've got wrong, and step on. But first thing you really need is some quality information in your portfolio. It doesn't have to be really high quality. You just need someone to look at the baseline position of where you are, and then be able to compare that with the markets. And it'll give you a sense of whether you're above or below where you want to be. And then you need to work your way down the path. We all kind of agree that 2050 is a huge target to get to net zero. You need a trajectory that somehow is going to get you from where you are now to there.
That makes sense. And then turning to the thorny issue of regulation, what is the role of the regulator when it comes to deciding investment priorities? And should trustees be finding it a help or a hindrance?
Well, any new layer of regulation is onerous, time-consuming, intellectually challenging for those being regulated. But the intention behind the regulation is mostly I was going to say benign. It's much more than benign. It's very positive. It's about trying to change the planet for our children and grandchildren to make it habitable. Again, it's easy to get completely bogged down in the technicalities, but that's what your advisors are for. They can help you with the TCFD reporting. If you're big enough and TCFD is biting you now, you should be finding that something you can resource. It's not an easy ride, but it's no worse than the accounting you're probably having to do for your schemes anyhow. For smaller schemes, it's more of a challenge, but actually you don't have to get into all of the detail on that. You have to work out a few priorities and go with the flow. I think there are a number of areas in the regulation where people have overcomplicated things, but if you come back to, how does your portfolio compare with the market? That's understandable. Nobody needs to understand the details of climate value at risk in a small scheme. That sort of thing is way beyond the requirements of those around the table. We just need to prioritize the simple stuff.
And to what extent do we think that member views should be taken into account? And if we do think that they should be taken into account, how can trustees kind of reasonably canvass and use those views appropriately?
In practice, that's a really hard thing to get right. It's easy to ask your population, write out to all the members, but the vast majority of them don't respond, and often those that do respond have strongly held views and are particularly kind of voluble in their exposition. I think there's a degree of judgment, and this is kind of one of the places we're having a mix of member and employer-nominated reps around the table, and allows you to kind of feel the pulse of the organisation and take a view as to what's appropriate. I think you need to split DB and DC on something like this, but in practice, when you poll members and ask them if they want kind of radical green options or even light green options in the DC portfolio, you get a very positive response to the words and very little money follows it. On DB, I think it's as much to do with your engagement with the employer. And if the employer is supportive, then we all know the trajectory we need to be heading in. It's just a question of how quickly we move down that path.
And then lastly, just like thinking about investments more specifically, are there specific asset classes that trustees should be thinking about that lend themselves particularly well to ESG when they're kind of making these decisions and setting their priorities?
Well, I mean, to be a bit simplistic, yes, there are two. There's equities, and they should be looking at them, and there's fixed income, bonds, government instruments, and they should be looking at them. And you don't need to use precisely the same methodology across both, but there are ways of screening those asset classes. There are ways of influencing the issue of those assets. They're different in the two camps, but you need to go down both paths, and you need to engage. I think where it gets more tricky is less actually about asset classes, and it's more about asset wrappers. If you've got somebody who's running a long, short, emerging market, something or other fund, getting line of sight as to what's happening with the actual investment exposures at the bottom of that is hard. If it's a conventional long-only bond or equity portfolio, it's relatively easy to see what the carbon intensity of that portfolio is, and for you to then decide whether you think that's the path you want to follow. Separate point is specific exclusions, and I think we all agree that there's a very short list of companies that you should be going nowhere near. What's debatable is the much longer list of companies that some people believe we shouldn't be investing in. But again, it's relatively easy to see those sort of exposures. You just need a simple set of rules, and then you need to abide by them as an asset manager.
No, that all makes perfect sense.
Right.
So obviously, we'll be discussing these issues and lots more at our conference later this year, and I can't wait to hear more from you then. Thank you.
Thanks very much.